Hey there, and welcome. So today, we are going to demystify the world of business finance. And listen, forget those dusty old accounting books. We're going to treat this like a health check. We're learning how to read a company's vital signs to figure out if it's thriving, just surviving, or in need of some serious care. Okay, let's just jump right in. Because at the end of the day, almost every question in finance boils down to this one simple thing. Is the business healthy or is it sick? That's the diagnosis we're learning to make, and it's the question we're going to answer together by getting you the fundamental tools for checking out any company. You know how a doctor uses a stethoscope or an X-ray or blood tests? Well, in business, leaders and investors use financial statements and ratios. These aren't just a bunch of random numbers. They're signals, right? They're clues to what's really going on under the hood. So let's grab our metaphorical lab coats and get to it. Every good health check starts with the basics, right? The core vitals. And in the world of business, that means we're looking at three primary diagnostic reports. And trust me, these three reports, they are the absolute key to unlocking a company's entire financial story. So first up, we've got the balance sheet. Honestly, the best way to think about this is like an X-ray. It captures a single static image of the company's financial bones on one specific day. On one side, you've got assets, everything the company owns. On the other side, you've got liabilities, everything it owes. Simple as that. And healthy balance between those two is absolutely critical. Now, if the balance sheet is that X-ray snapshot, then the income statement is the video. It doesn't show you just one moment. It tells the story over a period of time, like a whole quarter or a whole year. It's kind of like the financial movie of the year, showing you all the money coming in, all the money going out, all leading up to that final scene. Did we make a profit or a loss? And finally, there's the cash flow statement. Now this is the circulatory system of the business. It tracks the actual cash, the lifeblood, moving in and out. And this is so important because a company can actually look profitable on paper, but still fail because it just runs out of cash. This statement shows us exactly where that lifeblood is coming from and where it's going. So this is the big takeaway here. You've got to remember this distinction. One's a photo, the other is a movie. The balance sheet shows you where you stand right now. The income statement tells you the story of how you got there. And you absolutely 100% need both to get the full picture of your patient's health. Okay, we've got the basic reports. Now it's time for our first critical diagnosis. Is the patient stable? Before we can even dream about things like growth or huge profits, we have to know, can this business simply survive on its own? And that brings us to a really practical, really fundamental question. In fact, this is the question that keeps pretty much every new entrepreneur staring at the ceiling at 3 a.m. At what point do we actually stop losing money? This isn't about getting rich yet. This is just about getting stable. And that exact moment has a name. It's called the break-even point. It is the magic number where your total sales perfectly cover your total costs. You're not making a profit, no, but, and this is crucial, you're not losing money either. It's the first major milestone where a business proves it can stand on its own 2 feet. And hey, finding this number, it's not black magic. It's actually a pretty simple 3-step recipe. First, you just add up all your fixed costs. That's stuff like rent and salaries that you have to pay no matter what. Second, you figure out your contribution margin for each thing you sell. Just think of that as the little bit of pure cash you make on one sale before you pay for all that big stuff like rent. Finally, you just divide your total fixed costs by that little bit of cash, and boom, that tells you exactly how many things you need to sell just to survive. So let's say we know our patient can survive. Great, but is it actually thriving? To answer that, we need to dig a little deeper than just the raw numbers for our vital signs and really understand the story they're telling us about the business's health. And this is where profitability ratios come into play. Think of these as our expert interpretation of the lab results. They take that raw data, like revenue and profit, and they put it into context, which lets us judge how well and how efficiently a company is actually performing. Now, there are a ton of ratios we could look at, but today we're going to zoom in on one of the most powerful ones, the net profit margin. This ratio answers a really beautiful, simple question. For every single dollar in sales that comes through the door, how much is left over as pure profit? So let's imagine our company here had a net income, that's the final bottom line profit after every single expense and taxes paid, of $20,000 for the year. And to get that $20,000 profit, the company brought in $100,000 in total sales or revenue. Okay, so we've got our two numbers. What in the world does that actually tell us? Well, when we divide that $20,000 profit by the $100,000 in revenue, we get a net profit margin of 20%. And here's what that means. For every single dollar that came in, after paying for the products, the rent, the salaries, the taxes, everything, the company got to keep 20 cents as pure profit. That one number tells you so much about how efficient a company is. All right, so our patient is stable. It's showing healthy profitability. Now it's time for the final stage of our checkup. We have to decide on a treatment plan for the future. This is all about using what we've learned to make smart bets on investments that will make the company even stronger down the road. And here are our main decision-making tools for that treatment plan. First, you have net present value, or NPV. It basically just asks, will this project add real value to the company? Then there's the internal rate of return, or IRR. That's just the project's fancy percentage return, and you want that to be higher than what it costs you to borrow money. And finally, my favorite for its simplicity, the payback period. It asks the easiest question of all, how fast do we get our money back? Each one gives you a different, vital piece of the puzzle. Let's just look at a quick example with that payback period. Say we invest $10,000. Year 1, we get $3,000 back. Year 2, another $3,000. By the end of year 3, we've gotten a total of $10,000 back. So our payback period is 3 years. It's just a fantastic, simple way to measure risk, because the faster you get your cash back, the less risky the bet is. Simple as that. So there you have it. We've gone from reading the basic vitals to understanding survival, to measuring profitability, and even evaluating future treatment plans. You now have the fundamental diagnostic toolkit for business finance. So the only question left is, with these tools in your hand, which future would you bet on?